RCM is a privately owned independent asset management company that invests only in undervalued businesses. RCM has 41.6 billion rand of assets under management. Linda Eedes, portfolio manager at RCM, joins us in studio to chat about their global fund and, of course, their approach to investing. Well, we know that you are deep value investors. Right now, Linda, are you seeing more opportunity in the developed space? Can you basically, with your high level of conviction, accumulate further the stocks that you have decided offer value?
Well, given that we look for sort of deep value, as you say, undervalued investment opportunities, you'd expect us to be looking for value in the places that others aren't necessarily interested in. So some of our recent investments, which you'll see in the top 10 there, include retailers, in Europe. We still have some exposure to Greece. Coca-Cola Hellenic we can perhaps chat about, which is actually listed in Greece. Some opportunities in Japan.
Well, let's stop there and let's unpack each of these stories one by one. That, many would say, is a brave play. Besides perhaps investing in Greek banks, in terms of a retailer that is exposed specifically to Greece, why this play?
Okay, well, Coca-Cola Hellenic Bottlers is actually the world's biggest independent Coca-Cola bottler. And they actually are listed in Greece, but their predominant markets are Nigeria, Russia, and Poland. So actually their revenue stream is very emerging market oriented.
So it's limited. I mean, it's not, when I say it's limited in terms of exposure to Greece itself,
yes,
when it comes to their revenue.
Yes, in fact, 2/3 of their revenue actually comes from emerging markets rather than Greece. But they actually sort of supply 28 regions internationally.
I want to just flip your question the other way around. Given the market pullback that we've seen in South Africa the past month or so, or 2 months or so, has South Africa become any more compelling to you now than it was, say, 8, 12 months ago?
We have found some investment opportunities in South Africa, and particularly in the resources space. So we've started investing, not in this fund, although we do actually have some exposure here, but this is a global equity fund, but across our mandates in platinum stocks. We have started taking a position in Anglo-American. So typically the stocks that you've seen underperform, that's generally where we get interested. But globally, we're finding a lot more interesting investment opportunities. Europe, Japan, even in the US, multinationals with very diversified revenue streams that are out of favor at the moment. So the global situation is still looking a lot more interesting than the domestic situation.
How is Japan paying off for you? Because you've obviously been invested for some time now in that space. Are you starting to reap the rewards, or are you still waiting for some kicker to come through?
Well, in our top 10, we've got a Family Mart, which is essentially a convenience store format, very similar to 7-Elevens. And that's done very well over the past year. The opportunities in Japan are in some of the large caps, but particularly those with a domestic focus, and Family Mart is one of those. Tokyo Gas is another one, but also in the small cap space. There are about 2,700 companies in Japan which are not at all covered by sell-side analysts. So it's very much ignored market. And of those companies, there are quite a number which are trading at below their book values.
The Japanese market went nowhere for 23 years. Is that situation now reversing? Perhaps that's the broader question with regard to Japan.
Well, it's a very bifurcated market, and one would want to avoid the large companies on the manufacturing side, which are obviously also suffering from competition from China and Korea. The investment opportunities are very much security specific. There are still some huge issues in the corporate sector in Japan, and that's why, as bottom-up value investors, we feel that we have an advantage in terms of identifying those companies which do offer value rather than are value traps.
Would another theme, sorry Hlelo, I'll defer to you in a moment, would another theme be in Japan that you would also look for stocks very similar to your Coca-Cola Hellenic, where their revenue is generated from outside of Japan?
Yes, yeah. We do have a company, for instance, Hamamatsu Photonics, which does sort of the lights for scanning equipment, that side of medical equipment, and their market is obviously global, but again, they are a Japanese stock, and Japanese market in general is out of favor still. So that would be a good example.
When you build your portfolio, you obviously build it from a valuation standpoint first before anything else. But when you're done building it and you look at what runs through your portfolio, is there any kind of particular theme that you see? is it a sectoral theme or a consumption theme, or is there any kind of theme to it?
Yes, well, we do have some themes that sort of, percolate, as you say. We have got quite a few stocks which are on the technology side. So some of the high quality companies such as Microsoft, such as Dell, which are obviously, also part of the global cycle. And so also, experiencing some of the difficulties that, companies globally are experiencing, but which have substantial barriers to entry. So there's the technology theme. There's some pharmaceuticals which are coming out. And then, as I say, both domestically and in the global fund, we're starting to invest in some more of the resource stocks, which we regard as high quality companies.
Which stocks in particular in the global fund have you got access to, well, not access, that you are invested in the resource environment?
In particular, Amplats and Lonmin.
So the platinum story then is
Absolutely.
big on the agenda for ECM.
Very much so.
Hello, how do you feel about the platinum story?
Well, I think everyone knows platinum is challenged, but I think more so than any place else, with platinum, you have to go for the lowest cost producer. And that unquestionably is Impala. Impala has also had troubles with industrial action, but from an operational standpoint, not so much size. Amplats is bigger, but from an operational standpoint, Impala is a better one.
Why then Amplats over Implats?
Well, we look at it from a slightly different perspective, which is to say that the businesses which have the highest operating margins have less room for improvement than the likes of an Amplat. So obviously there we are making a call on cutting costs. Amplats is at sort of half the operating margins of Implats. So, we think that that's actually a potential valuation opportunity.
If we see further trouble in the developed world, which by all accounts is likely, and stock prices come under further pressure, it goes actually to my first question, which is, do you use that then to accumulate in those stocks that you have high conviction? And I assume every play basically in the equity environment is a high conviction play for you.
Yes, indeed. We look at things from an absolute value perspective. When markets do come off, that gives us the opportunity to buy stocks which are selling substantially below what we believe they're worth. We're not trying to guess what the market's going to do, but certainly when the market does provide us with opportunities, the stocks that we would like to own, when they do come significantly below intrinsic value, we do pull the trigger and invest.
When I look at your top 10, it's very fascinating in terms of the sources of return that you hope to get from these sort of companies. The one thing that I do see stands out is the dividend yield should be higher on these shares. What other sources of return besides the dividend yield do you see happening here? Do you see growth in terms of revaluation upwards being a larger contributor to returns, or is it dividend and dividend growth?
Well, growth is the most difficult part of the equation to actually identify, because in terms of forecasting where growth is going to come from, it's nearly impossible to do that consistently. But within the dynamics of each business, you do need to make a call on that. What we do simply is we identify those undervalued opportunities, and we say, we have to understand why they're undervalued at this point in time, and then we simply wait for them to realize what we perceive to be their value, and that can take years in some cases. We've been fortunate with this fund in the sense that some of those undervalued opportunities have come about sooner than we expected, which is, over the last year, the fund has done very well. But over the full market cycle, we don't make a call on what the catalysts are going to be that are going to unlock that value.
One thing that I see taking place very often in the South African market is that investors tend to choose companies that are somewhat challenged with the hope or with the anticipation that the challenge will improve or the challenge will alleviate and some valuation uplift will take place. So they tend to choose an Amplats versus Impala or an Anglo American versus BHP Billiton. Philosophically, do you believe that it's better to get a car that's stationary started to get it moving, or to jump on a car that's really moving from an operational standpoint that has wonderful momentum in its business dynamics? Which one do you think it's better to?
I'm not sure if I really understand the analogy there either. Linda, you're going to give it a bash here?
Yeah. The way that we look at it, we first and foremost want to invest in high quality businesses. Right. So generally they've got higher barriers to entry. They have substantial economic moats, as they call it, which are going to protect their long-term track record of earning returns over and above the cost of capital. Now, the fact of the matter is that high-quality businesses just don't become cheap when everything's going well. If you want to invest in high-quality businesses when they are not just slightly undervalued, but 30% or more undervalued, generally there has to be something about them at this point in time that the market doesn't like. So that's where the contrarian flavor of our investment philosophy comes in. We will take that position, even though in the short term, sometimes that position can deteriorate further before it actually realizes value ultimately.
Let's touch briefly on Harmony. Now, I know we're moving off the global fund, but I know that has been a strong play from RCM. You still stand by that position? Obviously, you don't change midway, do you?
Yes. Well, Harmony, we actually sold down the position because it actually did quite well, and sort of a year, 2 years ago, everyone was asking us about our position in Harmony, and now, it's actually looking, attractive again. So we do have a position in Harmony, but as I say, all of our investment.
When you say it's looking attractive again, would you accumulate at these levels?
We have accumulated slightly from the levels we were at previously. So we have a value that we've placed on the business, and the market price movement we will use simply to increase that exposure or decrease that exposure depending on how far away it is from the intrinsic value.
Did you sell down aggressively when it hit, obviously, the value that you deemed applicable?
It never quite hit the value that we put on the business. So as that margin of safety decreases, as that discount between what it's trading at and the intrinsic value decreases, we lighten the position, but we never sold it out completely because it never quite got there. An example of the opposite is something like a Tiger Brands, fantastic high quality business, but it just simply went way beyond our fair value and we had to sell out completely. So Tiger Brands we held for several years, now we don't hold anything in the stock.
Let me just ask an interesting question here. If you look at your asset allocation, well, actually your geographical allocation, South Africa and Australia, obviously the two best performing stock markets in the world over 100 years. You have very little allocation to them. Is it that you're betting against a 100-year trend here, or that this time it's very different? In other words, the divergence in valuation is so big that it's worth betting against a 100-year track record?
Yes. Again, we look at each specific investment idea in itself. But it's an interesting story, the South African success story, because 10 years ago, investors weren't interested in investing in South Africa, and it's turned out to be a great investment. And we've had exposure to it by virtue of being based in South Africa, but many investors were fleeing to take offshore exposure. Now it's the complete opposite. We see less compelling reason to invest in emerging markets, including South Africa, or the greater African story as well, and more reason to actually invest in those markets which have underperformed over the last 10 years.